If you trade crypto in the UK, you have to listen up. From the 1st of January 2026, HMRC will have a direct feed from all the exchanges directly into HMRC. That means they can track all of your ins, your outs, your profits, your losses, the fees, everything you've done on the blockchain. They will be able to see in an automated fashion. There is nowhere to hide anymore. They'll know every single wallet you have, how much crypto you've sent from every wallet, no matter how big or small those transactions are, they will know it. And what's even worse is that your tax bill will be preloaded into the system before you've even clicked submit on your self-assessment. So if there's anyone in the UK that you know that trades crypto, you need to send them this video right now. Because in this video, I'm going to give you three things. The first one is I'm going to give you an explanation of this new rule change that's happened in HMRC that's going live on the 1st of January 2026. Number two, I'm going to give you the 7 biggest questions that the community has about this thing. I'm going to answer them in a very simple format. And number 3, I'm going to point you to an absolutely free resource that you can use right now. That's just going to give you 8 actionable things that you can be doing right now with your taxes that's going to allow you to slash or defer a lot of that tax that you might be paying in your crypto this coming tax year. I'll explain that free resource a little bit later, but if you want to just go ahead and just get that resource right now, I've made a mini course. It's a 50-minute video course that you can take and it will help you understand everything that's going on with this new HMRC update rule. It's completely free. The link is in the top line of the description. So HMRC currently has a framework that allows exchanges to submit that data to HMRC, and it's called the CARF framework, CARF. That's the Crypto Assets Reporting Framework. Now, the CARF framework in its current system is very manual. HMRC have to manually go into the exchanges, request a specific record on a specific person's account, and it's very manual. It's kind of really difficult. And I think for the most part, most investors are pretty happy about that difficulty because HMRC aren't looking too carefully at your specific account. You kind of have to flag their system in some way for that to happen. But the CARF system is getting an update on the 1st of January 2026. So instead of it being like a flagging system and then they manually go and check, the new CARF framework will be an auto stream of data every single day from every major exchange into HMRC, basically allowing HMRC to see if you've underreported or not reported at all your crypto profits that they can clearly see. So they preload your account with what you should owe in crypto, in tax from your crypto, and it becomes way easier to flag and make contact with you. And this means more audits, more fees, more worries, and just more stress in general. So this is going from a manual piece of work to an automated piece of work. Lots of people are going to get in trouble with this. So if you miss or underreport by £1, the system knows it and flags it. And so obviously this becomes a massive worry for people in the crypto space, especially in the UK, because now people are thinking, well, I'm in trouble here. I haven't been reporting on my crypto and this is just really bad news. And in fact, it is. I also have to say this is what happens when you move towards centralization, as blockchain and crypto will naturally become. And even in decentralized environments, there will be centralized elements that allow access and visibility to these things. Extra money is being made by different people. The government want a piece of that. That's always going to happen. It's going to happen in crypto. It is happening in crypto. It's just about to get worse on the 1st of January 2026. So I've posted about this on Instagram a couple of times. Both times got 30,000 views and so many people followed on my Instagram because of these posts, because I know this is top of mind for a lot of people. These are the most asked questions in all of the comments of those 2 posts. So it's my hope that these questions are ones that you would also have as well. And I'm going to answer these questions right here. Question number 1 was, can I deduct my losses in crypto? So the quick answer here is yes. But there's a caveat, only if you realize that loss. And so this is basically tax loss harvesting, which we cover in great detail in the free mini course that you can click in the description below. Well, what a lot of people do is something called tax loss harvesting, which is kind of the week or so before the end of the tax year. They'll actually sell any crypto that they're in a loss on and then rebuy those assets back after the tax year has finished, using that boundary really well. And so you can actually realize those losses, harvest those losses, and they will be deducted from your profits in the following tax year. Question number 2 was about assets in cold storage. Will HMRC be able to see these assets in cold storage? The quick answer here is absolutely not. Just because you have assets in a cold storage doesn't make them invisible. Here's exactly how it happens, right? So you get the CARF framework extracts that data from a KYC exchange, which is likely where you initially bought the crypto in the beginning. And seconds later, every wallet address that you've sent money to, crypto to, is now flagged and assigned to you. So it will know when you've sent your assets from an exchange to a cold storage. It will know what the wallet address of your cold storage is. There's nowhere to hide. I said that at the beginning. Question number 3 was, how far back can HMRC actually look? Like, how far back are they going to look to see if I've underreported? So the CARF auto feed that I'm talking about starts in 2026, but there has been something called Schedule 36 notices. They actually can reach back as far as 4 years in your history. So that's pretty normal. You can actually get those extended to 6 to 12 years if you've been a little bit careless or you've done things offshore. And to be honest, it doesn't even stop there. If they want to be more deliberate and more involved, they can go back as far as 20 years. But that basically encapsulates all of history in crypto. So they already have the ability to do it. But like I said at the beginning, it's not something that they do all the time because of capacity. They have to manually do these things. And then this is a lot of manual effort. All that manual effort is being overrun by this automated effort. It's not really the way to put it, but it's going to be an automated system that's going to do it all for the people that were doing it manually. Question number 4 is, do trusts or companies shelter the gains that you make? And so again, it's no, because as we talk about in the mini course, I highly advise you take the mini course because you'll learn everything about the nuances of all this crypto CARF stuff. With HMRC specifically, transferring your assets into a trust is what we call in the tax world a disposal. And so as soon as a disposal is made, capital gains tax is applied to it. But because there is such a thing called anti-avoidance rules and how they follow the beneficiary of a trust specifically, it's actually better just to get bespoke advice. We obviously have people that you can talk to in the Blockflow program, and if that's of interest, you just got to let me know somehow. But question number 5 is, what about VPNs and non-KYC decentralized exchanges? So what we're talking about there is clouding location in a VPN and then also a non-KYC DEX. Now, the reason why KYC is being brought up, KYC is called Know Your Customer. It's a little abbreviation. And this is the form that you fill out to identify who you are when you sign up with an exchange. Now, some exchanges don't have KYC. Those are called non-KYC exchanges. They don't require any identification from you. They're decentralized, and you can just trade your crypto in a decentralized, untracked way. The thing is about non-KYC DEXs is that you still need a fiat on and off ramp in order to get money into those accounts. And as soon as you've got a fiat on ramp, the chain is public. Like as soon as you've moved from bank account into an exchange, regardless of whether it's KYC, you're being tracked. Like they get you from every angle. And you wonder why these things take so long to play out. It's because there's a lot to think about. They really want the control over this space, so it takes a long time to do that. The problem with that is if you're using non-KYC, and the VPN thing doesn't make any sense because clouding your location doesn't change anything about the on-chain data. But if you start to evade the taxes in this way and think that that's a legitimate strategy, you're just adding risk to the whole situation here. And then foregoing any tax saving that you might have been able to get should you have declared. Question number 6 is, you only pay when you sell. Is that right? And so that's wrong, actually. So if you, for example, swapped one crypto to another crypto, that again is classed as a disposal. Just because you're not coming out of crypto doesn't mean disposals don't occur. You also have staking rewards that are treated as income the moment you receive them. Even if you never sell them, there are gains that would have to be taxed on. So you pay tax even if you're not selling. It's down to the disposal amount. How many disposals have you got? And what are those disposals? And do you have disposals at all? Basically, everyone has these tax disposals. That's the issue. And question number 7, can meme coin losses offset my salary tax? This is an interesting one. And so losses in this case are capital, and they offset future gains, but not your employment income. And actually the law on that is like just really clear. So there's no way around that. So I hope you can see from those 7 questions that they've really thought of everything. It's a shame, but they've thought of everything. They're covering all their bases. It's going to start happening on the 1st of January 2026. And I just think people need to be a bit sharper on kind of the strategies you can use from a tax perspective, using the border of 2 different tax years and setting things up if you have a spouse and all of that kind of stuff. And I cover all of that in the free HMRC mini course that's in the top line of the description below this video. It's absolutely free. I just want to give this as a resource for everyone to make their way through it and just educate themselves on the UK tax system. And so if there's anything else that I can help you with, just leave the comments below in this video, and I'll do my best to help. The likelihood is, because of how comprehensive this mini course is, the likelihood is that I've already answered it in the mini course. It's absolutely free. Click the link in the description, fill out the form, and you get instant access. So take a deep breath, get into that mini course, stay emotionless. I'll see you in the next one.